Was this rally based on something else besides fundamentals? What was it exactly? Well, joining us from his office in Manhattan, we want to welcome S&P Chief Technical Strategist Mark Arbeter. Thanks for joining us, Mark.
Hi, how you doing?
Very well, thank you. So why do you think the Wall Street analyst Lynn describes got it wrong back in March?
Well, it's fairly typical that the market will turn around before the fundamentals. That's sort of the value of technical analysis, both at major tops and major bottoms. The market always turns higher or lower before the fundamentals. The analysts are now, I think, playing catch-up here and waiting for the fundamentals to turn. But I think we are at least in a cyclical bull market here. And from my discussions here at S&P, a lot of the analysts here are waiting for the market here to pull back to reevaluate their stars rankings. And I think they're, analysts in general are kind of caught, behind the curve here.
All right, so just again, generally speaking, more and more people are characterizing this as a technical rally since March. First, do you agree with that description? And secondly, explain why that is.
I'm not sure what you want to call it. Sentiment indicators at the market low got very bearish. I think a lot of stocks and a lot of different industries were pricing doomsday and depression and going out of business type scenarios. The market has rallied sharply off these March lows. I think we've kind of recaptured some of that decline, that we're not going to go into a depression here. It's just a recession. And the market always leads the economy out of these recessions. So I think, we're in a cyclical bull market. I think that, over the near term, we could see a pullback here over the next couple weeks to months. But the market will finish the year higher.
The technical analyst I spoke with yesterday, Katie Stockton, said she also expects a technical pullback of about 5 to 10%. Where do you think?
Yeah, I'm looking for about the same thing. The S&P 500 ran into a concentration of resistance up between about 1,006 and 1,020. There's prior chart resistance from the early November highs around 1,006. The 1,015 level represented about a 38.2% retracement, so we had a Fibonacci piece of resistance up there. If we look at the consolidation that we saw during the months of May to July and take the width of that and add that to the recent breakout point, we could have a measured move up into the 1,007 to 1,020 level. So along with hitting a concentration of resistance, the markets, major indices got pretty overbought. Some of the sentiment indicators I looked at got too bullish here. So I think we could pull back about 5–7% into the 940 to 960 level or area on the S&P 500. That was the prior breakout point. The 200-day exponential moving average comes in down at that point. So we have chart support, we have moving average support, and then if we draw a trend line off the lows since March, it also comes in around the 940, 950 area. So I think we'll get this pullback, and then after this pullback, we'll be off to new highs again.
All right, Mark Arbeter, we sure thank you for your insights. Let's remind our viewers the S&P stands at 988 today.